First and foremost is I want to clear up this MOC questions that I get all the time. I actually should do a video just dedicated on MOC with an explanation because I get so many questions about it. So MOC is one particular type of order that large institutions tend to use. It just means market on close orders. And the MOC, when I put like MOC, you know, like today plus 600 or plus 700, that just means that the people who want to buy versus sell have $700 million more of stock to buy than they do to sell. That's all that means. It's fairly insignificant in terms of the effect on the market if it's anything below 500 million. Anything over $1 billion or more is more of a significant effect. I know a lot of people are like, oh, you know, how is this useful? It doesn't tell anything. The answer is this, is that the MOC doesn't necessarily have to dictate the close. It is very useful, though, to know what institutions are thinking, if they are more on the buy side or the sell side, particularly if you're looking for entries and exits into stocks. If you know that there's a lot of people looking to sell right in front, you know, right behind you, you might want to wait until their selling is out of the way. If you know there's people looking to buy, you might wait for a little bit more price improvement into the bell. It doesn't necessarily dictate what happens the next day. It is all very useful for same-day action. I also find keeping track of the trend of MOC very useful, meaning if there are multiple days of selling versus multiple days of buying, it lets you know that institutions, where their heads are, if they're thinking more. I'm trying to get the lighting right here. This looks so blown out. Anyway, they think if they're thinking more to the buy side or more to the sell side, and that is exhibited by multiple days. Like if you have MOC 500 million all week to sell, you know that companies, or I should say funds, are unloading. If there's buy all week, you know that they're loading up. If it's mixed, it's a little less conclusive. This is what MOC is very useful for. It is not necessarily useful for predicting where things are 100% going in the next couple of minutes if the MOC isn't large. So I hope that clears up MOC. If you guys have any more questions about that, feel free to tweet me about that or put comments in the rebroadcast of this. I'm going to post this on my YouTube channel. Okay, so yes, if you missed any part of this video, by the way, it is rebroadcast on my YouTube channel all the time. That is Justin Pulitzer Trades. If you're not subscribed there, please do so. So that was that. So the market has been a little bit erratic the last few sessions. It's been selling off on fairly low, fairly kind of middling volume, and the internals have not been overly bearish, except one day there was a bit of trend day type of internals, but even then it wasn't a trend day. It was just sort of ping-ponging back and forth. So it's a fairly low, there's low confidence in the market by buyers and sellers, both to the upside and to the downside. You can equate that to whatever you want, you know. I think it's just that the market had ran a lot and it had gotten into some resistance. I'm just pulling up my SPY chart. Sorry if I'm looking elsewhere. It had just run into some resistance up around 210, 211, which I had discussed. And I talked about booking some profits, and that was also some spots if you wanted to take a shot at some right or right out shorts. It's very normal that the market is backing off from those levels. It's not healthy just to go every day in a straight line. You know, if you bought yesterday, you want your stock to go up today. That's not really how the real world works here. That's not how the stock market works. You take it from level to level. Now, I know a lot of people have been pretty bearish about the market, and a lot of people are bullish, and then a lot of people just sort of don't know what the heck is going on. I was thinking to myself how I could how to kind of describe this market and what's been going on. And I think, most of you, I mean, who follow me, if there's anyone who's been following me for a while, probably knows I'm a big movie buff. And I was trying to think of a movie and a scene that would really describe what I think the market is like. And what came to mind was The Color of Money, actually, with Paul Newman and Tom Cruise. And there's a scene where they're in a pool hall trying to play some pool to kind of rope in some suckers, and Tom Cruise's character, Vincent, is supposed to be playing Fast Eddie, and they have this conversation. And Fast Eddie, I'm going to read it. I found the script online. He says, he goes, "This ain't pool. This is for bangers. Straight pool is pool. This is like handball or cribbage or something. Straight pool, you got to be a real surgeon to get it. You know, it's all about finesse. Now everything is 9-ball because it's fast, good for TV, good for a lot of break shots. Oh well, what the hell? Checkers sells more than chess." Very much, and this was Fast Eddie talking about pool in 1986, or was he talking about the stock market in 2016? Very, very similar. The market these days is not for surgeons necessarily. You know, that's why you see a lot of the old guard come on TV, and they're very frustrated because everything these days is really more for bangers. It's all technicals. It's a lot of guys like myself, and I suspect a lot of people who are watching this video who sit around and trade basically on technicals. I'll tell you, I trade stocks sometimes. I don't even know what they do. I just trade their charts. If it's moving that day and I see it has a lot of momentum in it, and I see that I think that I have some type of a technical edge, I'll play it. That's a little more rare for me. I tend to have a narrow set of stocks that I trade in, a pool, but I have done that before, I'll tell you. You know, the market, there are so many stocks these days, and I think it's just kind of people are chasing or playing what's moving, what's working, what's moving that day, particularly on Twitter. If you're not right in a stock for 5 minutes, you get tons of trolls and hate. I mean, you could be, let's say you're playing something long. If it's not working for 5 minutes, everyone thinks you're an idiot. If it's up for, you know, it's up for every period of the day, you're a genius, right? So I just thought that quote was very apropos, and I think it really describes the condition that the market is in these days. Anyway, I hope you enjoyed that little bit of a side note, but that is the backdrop that I think we're in. So I explained MOC. I explained that I think we're in a bangers market. I've been calling it a little bit of a junkie market. It's kind of everybody wants the quick fix. That's really what needs to happen. They don't necessarily care what's good for them longer term, as long as they're okay for that few minutes while they're chasing and watching their P&L. And I'll tell you, I don't know what account size that you get. You know, you guys and girls trade. I do know from my YouTube demographics, unfortunately, we don't have enough ladies. So definitely, maybe we'll do a ladies' night for video to try to attract some more ladies. But I think that's really what's been driving the markets back and forth, and it's sort of this junky personality that everyone has to be satisfied every second of every moment. And I could just see it on Twitter, and I could just see it in the tape and the price action. So we've had some conflicting data. Obviously, we're waiting for NFP. That's the big jobs number, the non-farm payroll tomorrow. We've had I'm just looking, the ISM, the manufacturing was a bit of a miss. The employment component to that, by the way, was recessionary, even though that the main number was not good. Again, you know, my theory about this with the job quality, I think Goldman Sachs, by the way, right after the bell is laying off like a lot of their fixed income department. You know, I'll tell you, working at Goldman Sachs or working at Applebee's, I don't know. You tell me which you think it pays better and which is a higher quality job position. So the services number was a little bit better than expected. So we have some conflicting data. Good for keeping the recession fears a little bit at bay, but not necessarily good for, also good for keeping the Fed at bay. The ADP employment number today was not good. It was a miss. I think this was the largest rise in claims. Was that? It might have been yesterday, ADP. I have to take a look. It's just been a busy day scribbling this stuff down. But it was not good. And you've had some stuff going on. You've also have that Sohn conference going on, which is just hilarious. You get guys. I don't want to mention any names, but some very famous short sellers who come on. And I'll tell you honestly, if I was presenting at Sohn and I knew I was going to be on TV, and I know markets are asymmetric, meaning they move down quicker than up, and I could talk my book, I would talk a short position for sure. You'll get the immediate bang right away in it, and these guys know that, and they're gaming that. So they give short ideas, and they talk about the world ending, and of course everyone is super bearish, although those guys tend to always be bearish anyway, right? I never really, I mean, they must be some miserable human beings, right? So that's that. You've had some notable breakdowns in some of the larger stocks lately. There's been a pretty nice bifurcation in the FANG stocks, meaning Facebook and Amazon did well, and then Google and Netflix have been kind of selling off a little bit, and then Apple, who's not really an official FANG member, but they are obviously the most important component of the Qs. Apple is doing something that I kind of predicted. I said I thought it was going to come down to the 92s bounce and have a bounce to a bit of a lower high and then potentially break. Whew. It's certainly looking that way. I'll tell you this, anything below Apple 92 is a right or right out short. You have to keep in mind a few things. What can happen with that issue? You can have a look below and fail, meaning it goes below and then goes higher. You could have a look below and go, or you could have those are really the two scenarios that I don't want to get into anything else because I think it's going to be a little confusing, but let's think about a look below and go or a look below and fail. A look below and fail will be a long, a look below and go is a right or right out short. So that is what I'm thinking with regard to Apple. I think that the stock, as long as it's sort of around this 92 area, I don't want to mess around with it because you could form poor lows also, and then it can rocket, back up, or you can form poor lows for a while and then have the breakdown. So I want to just kind of keep it as simple as possible. That is what I'm looking at. Someone was mentioning Netflix. Yeah, I mean, I'll tell you, Netflix was starting to look like it wanted to turn. It had a hammer. It had a trend break with a pretty powerful day, and then today it closed below the low of that bar. So, I mean, Netflix is kind of a bit of a bit of a hands-off. I had been playing it long. As a right or right out, and the trade kind of crumbled pretty quickly. That's okay, no big deal. Some other notable things. Oh, there's something I wanted to clear the air about quickly. I know it was a little controversial, and I would like to say that I apologize slightly for not looking at this sooner. I had been talking about Fitbit being a long, and then I changed my mind yesterday, late in the day. It was before the close, and there was plenty of time to act on it, and I got a few notes from people thanking me that they got out of it quickly. I just wish I had posted that a little bit sooner. It started out, I'll tell you this, honestly, I hadn't even planned on looking at Fitbit that day. I was just long. I was just assuming that I was playing the stock long. And I got a DM from a gentleman who was asking me about Fitbit, and for whatever, I started looking at the chart, and, I said to him, it's looking like the risk could be the channel low. And then I went in and I looked at the options, and I opened up the open interest, and I'm like, holy cow, I'm looking at it right now. I'm like, holy cow, I took a screenshot of it. I'm going to put this in the weekend review too, so if anyone wants to see this, exactly what to look for. I was like, wow, everybody is playing long. I'm looking at the open interest. These were from yesterday, and it doesn't include that day volume, but the OI from like 17 was 1900. Just going up in $0.50 increments. Then it was like 1789, 3644. These were all high OIs. And then I look over at the put side, and there was very little OI until you got into the 16 and 15 half area. And I said to myself, the boat is a little heavy. Think about if you had 10 men or 10 ladies in a boat. If you have half on one side and half on the other side, it's balanced. But if you have 8 on one side and 2 on the other side, it's a little bit lopsided, and it just seemed to me very obvious that the market makers were just going to sweep the legs out of anybody who was, long those calls. So I bailed. I think I got about $17 or whatever it was at the time. It turned out to be very prescient. I wouldn't say it saved me a lot of money because I didn't have a lot of position on in there, but it definitely. Anytime I think I'm going to, be in a losing position, I, at the very least, like to take some off. And that was really what did it for me. The report was okay with Fitbit. I mean, their numbers were all right, but their guidance wasn't great. I'll tell you this. I was having a conversation with a buddy of mine over DM today. He had been long also and had gotten out. And we were talking about Fitbit, and I was saying I was debating buying the channel low today. It wound up closing below the channel low, but it was right when it got to the channel low. And he's like, oh, well, what are you doing? And I was like, it's really a tough call here. And I said, I'm not short. I wish I was, but I have to be thinking if I was short, I put my short cap on, my short yarmulke on, right? I actually have a Yankees yarmulke, as crazy as that sounds, but let's not get off topic. I was thinking to myself that if you're short, you have to be thinking the stock is going to retest the old all-time low. You had a gap and go below the 50 MA, and the stock was just looking crappy. You've had four downdrafts on quarters, and it just seemed to me that the stock was probably not going to trade well. Plus, I know the market's been a little squeamish the last few days anyway, and all of that, all information in my mind, a trader's mind, is grist, and I use it. And I tweeted out last night. I said to really be a successful trader. Originally, I had written to be a great trader, but I changed it to successful because I don't necessarily consider myself great, but I would say that I'm relatively successful at trading. And I said that to be a successful trader, you need to be able to have confidence in your ability to recognize an opportunity and then basically act on it. I forget the exact wording I wrote. I actually should save it. It's a good one. But that's really what it really means. And I saw what I saw yesterday, and I just had confidence in my ability to make the right decision. And honestly, it was against what I wanted to do. I wanted to be long Fitbit into that print. I liked the new product that came out. I thought that the stock was down a lot, but the numbers and the setup just did something. Was a bunch of things weren't hitting. And it just struck me as I needed to be out of the situation, and that wound up being really the right call. So that I wanted to walk you guys and girls through my mental process of how I came up with that and some of the things I looked for. That's how it is. You have to be dynamic and flexible in the stock market, and I'll tell you honestly, the minute I think I'm wrong, and this is so counter to human nature. The minute everyone wants to be right, I'll tell you this. This could possibly be the most important thing I tell you guys, and it's not the SPY levels. This is really how I think and how it's done. Everybody wants to be right, but what they forget about is there's a little step in between. You have to first stop being wrong. Very, very important. And the only way you can ever be right is if you first stop being wrong. So I always want to be right. But I don't want to be right because of my idea being right. I want to be on the right side of the trade. And that's really the key here. And for me, I either want to be flat or on the right side. That's just it. And for me, with Fitbit, it was either flat or at that point, believe it or not, I was thinking short. Unfortunately, I didn't do that, but it saved me some bucks, and I hope it saved you guys some money. And I hope that this conversation helps you think that way on your own. That's really my goal, is to help you guys be able to make these decisions and benefit from that experience. Someone was messaging me today. I don't want to mention anyone's name in particular. If someone messages me, it's in confidence. But I'll tell you, I get this basically a carbon copy of this message at least 2 to 3 times a week via either email or DM, or even sometimes outright on the stream. And it's somebody who was trading, and they said that they've haven't done that well recently, and they were curious about how some of the methods I use, and if I teach, and so on and so forth. And I do these videos, and maybe I'll do some more tutorials about trading when I do launch the paid service. I think that would only be fair. Those are going to be very in depth. Those would be very, very in depth videos, but I'll tell you, a lot of trading is just experience and learning how to read tape and thinking about other people's hopes and fears in the market, and kind of understanding what the tape is telling you, what the message of the market is, looking at the internals, looking at the breadth, looking at sectors, looking at what some big stocks are doing, looking at the mood of traders. And I don't mean the mood of these buffoons who come on, these TV guests who look and see if the market's down 100 points, I'm going to be bearish today. It's up 100 points, I'll be bullish. They probably write 2 things that that morning with at breakfast. If the market's up, I'll say this, and if the market's down, I'll say this. That's not the way to give advice, but it is proper. It is the proper way to trade that moment. So that's sort of what I'm getting at. Anyway, let's get more into some of the stuff here. Do I have any literature? Yeah, the book. All right. So if you want some book recommendations, someone just asked. This is really the forum for this. Believe it or not, these are the better questions. In this video, I think you'll take more away of than me saying, be long this over this and that short over this under that, because this really teaches the process. I know everyone wants, to have their fish caught for them, filleted for them, grilled for them, and served for them, and in some cases, believe it or not, even ate for them. But longer term, God forbid, if I were hit by a bus or something and I couldn't, give you my levels every single second, you'd at least really know the process here. So the books. I have a book that I read almost minimum once a year, Reminiscences of a Stock Operator by Edwin Lefebvre. And the follow-on book to that is How to Trade in Stocks by Jesse Livermore. I am a huge Livermore fan. I'm like even into the psychology of Livermore. That's a really great book to read. I really wish I knew about that when I was younger. That book can really change your life. It's like if I were caught on a desert island, probably that and the Aeneid would be the two books that I'd want to have with me. Those two books are great, though. Reminiscences of a Stock Operator and How to Trade in Stocks by Jesse Livermore. He actually wrote that shortly before he died, and it's a little bit more comprehensive. Reminiscences covers before the 1929 crash, and then the other one picks up, believe it or not, after 1929 when he made $100 million in like a day or something in the crash in 1929. So it's a really interesting book, and I think his risk management discipline, listening to him later on in life, was actually very, very useful. And you could tell how he matured, and he had really gone on and better in his at the time better on in his life. There's another book, The Psychology of the Stock Market by Selden. It's amazing to read these early 1900 books and think how sophisticated the traders were back then. I honestly think that in instances they were smarter then than some of the guys I hear now. Fantastic book. I actually should reread that. That's a really good one. I like that. I'm going to put that on my reading list. Then there's always, like Mind Over Markets and, Trading in the Zone. Those types of books are really good. I don't want to focus too much on that here anymore, though. I want to get into the market. So you've had a lot of Fed speak. The same guys again and again, Bullard and Lockhart. I just wish these guys would just shut the F up already. They have been wrong on growth. They've been wrong on their economic forecasts. I mean, I don't know what these guys do. I mean, you'd think they sit around and smoke weed all day and then come on and they giggle and laugh and talk about rate hikes. There is nothing in the data that I see that warrants a rate hike. If anything, they should be more accommodative, lower for longer. I really believe Yellen's speech was a game changer. I had been more moderate to bearish before then, and then after that I started thinking that we have to be a little bit more bullish to the upside. And I started thinking that we could make new highs in the market. I still believe that. I will say this, though. Short term, there are a few technical problems that are in front of us. We had poor lows again today. I don't necessarily know if they repair and then we go higher, or if there's the higher and then the repair. It's probably healthier if it's the repair and then higher, because it would be more sustainable. There's also a bit of the sell in May and go away crowd. So seasonally, this isn't the best time in the market. We're also starting to roll over a little bit in the stochastics, but I'll tell you, as bearish as everyone is, and I think that most people are a little bearish, although my poll I took about how we're going to behave tomorrow was a little bit, at last I looked, was a little bit more bullish than bearish. We're still above the 50-day moving average. We're still above the 204.12, and I'm talking SPY now. We are still above it's really 203.87. That's a level I don't like to talk about too much, but it's an important one, to 204.12. Anytime we've had these like disgusting gap down Mondays or gap and goes, it's always been with a close below 204.12. If we close tomorrow below 204.12, you should be a little bit cautious. If it holds, then I would say we're kind of a little more hunky-dory. We have a 2-day high that has resisted roughly in the same area. The key level there is the 205.23, which I don't like that we closed below today. That's a little more iffy to me. And also the 205.92. That was, what was today's high? 205.98. So we had a little bit of a look above, but we still closed below those levels. As long as we are below those levels, I have to be a little more cautious. But until we really definitively have a close below 204.12, I'm still thinking things are a little bit okay. If that were to break, the next level is 201.90, and you have the 200 MA around 201.39. It seems like we'll probably, I would think we'll get a 50 MA bounce here. We haven't touched, we broke definitively the 50 MA in February, and we haven't had a touch. We know we have a ton of support down in like these 203, 204 levels. So I would think after, multiple days of consolidation and selling that it probably will hold a little bit. The expected move in SPY tomorrow, given all the hype around NFP, is relatively mild. It's only expected to be $1.64, and you don't really have that high of a VIX. That is a little bit, there's two ways to look at that. One, you could say, okay, the market knows something that we're going to be okay. Two, you could say that the market is a little bit complacent. I'm a little on that side. I would have preferred if we would have gotten a little more panicky today, if we would have had a more of a flush low. We don't. So we'll have to see how this is going to play out. We did, in terms of ES terms, we closed a little bit shady. The Yellen day, the VWAP of that day was 204.45 half. By the way, if you want to start writing down levels and know like how I think with my levels, why they're always so hyper accurate, because I take these meticulous notes. I was talking about the market for bangers. I can be a banger and I could also be a surgeon. This is my brain surgery of the market. I write down VWAPs of Fed days. I write down highs and lows of Fed days. I take note of important areas where the markets have had resistance or support. Those levels wind up being very important later on, even sometimes a few days later. People will take note of it that day and then forget about it. I'll tell you this, as long as the market here, in my view, is below the 204.45 to 2041 half, which we did close over, so we kind of sandwiched in between there. It's a little iffy. Above there, above 2052 quarter, that starts getting a little bit more terra firma, so to speak. So those are my levels with regard to SPY and ES. I often commingle them. It's just kind of how I roll. It's all the same, right? All right, same. I'm looking at IWM. That kind of, like I said, I was talking in my video a couple of weeks ago that it was getting into the box. If you've watched my videos before, I've discussed the box. The lower end of range of the box is 214.29, and we had a bit of a look above and then back off. That is really not so surprising. We're, again, just coming down into the 50. It hasn't broken the kind of flag trend yet, so it's hard to say that it's super duper bearish. I think that the sheen of the IWM is more attractive with a bit of a stronger dollar because it's more domestic and the dollar has been down a bit. I'll tell you, IWM, it broke the downtrend. Now it's back inside the downtrend. It's below the 200 MA. That was really a key level for me. So and we've had a break of the 200 and a failed retest. I'm a little cautious on IWM. I'll say that. If you can get back above the 200, I'm a little more terra firma on IWM. Below 200 MA, I'm a little iffy. Caveat, though, that we are still above the 50. So it's just, it's in that area. Some of the other risk-on, risk-off issues, and someone beat me to the punch here, is IBB, but I'm going to talk about Qs first. Qs are really right in the middle of the range. It's now coming up with a bit of a lower high, and we're coming back down. That is below the 50, below the 200, and below the 100. That is a little bit more concerning. We are right into a high volume node of these 105s, so 104 to 105 is a really key level. If we can hold there, it's sort of okay. If it gets below there, it starts getting iffy. And remember what I talked about with Apple. If Apple snaps, you're going to have problems in the Qs. It's just how it is. I often talk about when I play Apple earnings, for example, if you want to hedge, you could be long Apple and short the Qs. It's sort of like a football bet. Betting a team to win and then taking the money line on the other team as your hedge. How do you like that? That's the I'm teaching you football betting here. I'm good at horse racing also sometimes. But this is how I would think about this. So Qs are really key here, particularly with Apple. And the Goog. I mean, Google is really important too, and that's not looking super fabuloso to me. It's at a bit of the end of a volume distribution, but I think that there still could be a little risk down to the 680s. The channel low would be like 660. I'm sorry, the interim channel. The real channel low is significantly lower. That's like 630. I don't like to mess with Google in between the channel. I like to short it at the channel high or buy it at the channel low. And over time, Google is obviously a bullish stock, so I'm more of into the buy it at the channel low type of a guy. So that's the Google. Netflix, I was talking about that a little bit before. Also a little bit iffy. Anything below 89.89 is a little iffy. If it starts breaking 88.21, it's probably going to see 86s. I mean, this thing could see 80 very easily. It wouldn't surprise me. If you can get back up over the 2-day highs, over the night, let's just say clear 92s, then I think you can get a trade back up to the 99 to 101 level. That's just Netflix. Amazon, it's still holding in the, it's still above the gap. This got exactly to target. I was talking about 675.89 to 684.82. What was the high here? 685.50. So it did get a smidgen above there. It's just I think it's just digesting the gap. I don't necessarily know if you're going to get a gap fill right away here, but it's possible. I mean, I actually like put ratios to play for the gap fill, but I don't know that it's going to go so quickly. I think it could be just a consolidation and then gently maybe come in. It's going to depend a little bit on the market. If the market starts coming in, you're probably going to have some problems. Seasonally, this isn't the best time for Amazon. It's sort of more of a, it's sort of better toward the later part of the summer going into the holiday season. The Facebook is looking like a champion. Yeah, I make up words sometimes. Yeah, it's looking good. Anything over 116.07, I'm still kind of thinking more higher than not. I would love a pullback. If this thing could fill the gap, it would be great. I would love to sell some more puts there. But Facebook, I think it just got to the progression line. It's crazy with this progression line where it shows it, but it basically got there and it's backing off a bit. I think it just is consolidating a bit and dealing with the market. Facebook and Amazon had spectacular quarters, and I think that those stocks are back to the buy the dip list. I don't think the next Netflix one was so terrible, but I think that there's some concerns about their potentially growth and issues in China, but we'll see how that plays out. IBB, that could be setting up for some trouble. I'll tell you why. I don't know that this is the case yet. It hasn't confirmed, but it could be setting up for the third wave. For all you Elliott Wave, fans, I did a 1.618 Fibonacci extension. That would take you down to 212.08. There's reference lows around 207.48. We could be going there. I think that point it would be a right or right out buy. We broke trend. Listen, anything below 271.77 to 275.40 to me is vulnerable. We broke there. We kind of futzed around, and now we have a trend break. Today was a bit of a hammer. It wouldn't shock me to see it hit the 50 MA. I actually like the 50 MA since that was the breakout, the initial hold, and then I would like the 50 MA as a row short. That is actually, it's the backside of the trend line and the 50 MA. I like it as a row short with a tight leash and you could do a close, a few bucks. If it gets back a few bucks higher, you can be stopped out. Gilead, cheap stock based on earnings, only 7 times. The problem, and this is the problem, you have to believe those earnings, and I believe all of these drug companies, given what Trump and Hillary and Bernie Sanders are all saying, the best days are over for these guys being able to all, get the margins and the prices they want for their drugs. If they have lower margins, there's less R&D and there's less pipeline and so on and so forth. This, believe it or not, looks like a really large topping pattern. The key here is for it to hold 81, 89 to 84, 88. It's come down hard and fast from 103. I think if you can get it in the 81s, I would, in the next day or so, if there's some kind of more pukage, I like selling puts, for very near dated puts for a bounce. I think the bounce is going to be to a lower high, but it is playable. I sort of am just a little hands off with these here because I want to see how this plays out. Someone asked about Tesla. So Tesla just got to the level I talked about. I said it was a sell at the 265s. I guess I was a moron because it got to 269.34, but I guess I'm pretty smart today because it's 211. Yeah, it just ran too much. This was the same problem I had in Win. You're a long way from Toto, Kansas Toto. The 50% fib is 203.76. We know 205.20 is an important level. And then the 190.06 to 191 area is important. I would actually be interested in that 61.8 for a put sale. We know the flash crash low was around 195. I think in the 190s it could be, since it's come down so hard and fast, I'd be into selling some out of the money puts there. That's sort of my thoughts on that one. All right, I think we covered a lot, and I actually have to boogie for an appointment in the city. I'm out in the BK here. Anyway, I hope my video was good. I think you guys, I actually thought today's video was really fantastic, if I do say so myself, because we were able to really not only talk about just technicals, although I think we got into some of the key levels there really quickly, but I think we were able to talk about some of the methodology behind, sort of behind the curtain, I guess behind the Oz curtain a little bit. A lot of, I will say, I want to just leave it on this. A lot of people are always like, oh, how do you know this or that? I don't know anything. All I know is what is high probability or what is lower probability. And then based on experience, take trades I think are high probability or low probability. Also, just recognizing tape action. This is really what I would suggest doing. If you're really struggling in the market here, just watch the tape. Look for patterns. Look for setups. Watch the videos. Look what I'm looking at. This is what traders look at. This is what's important. One last thing with regard to tomorrow, like I said, I don't know if we're going to get the repair tomorrow first and then the move higher, or if we're going to get the move higher and then repair a little bit later on. We've been selling off for the most part of the week. The market is looking to me a little net short. It just looks like you're getting squeezes and rallies, and it looks like people are short. So it wouldn't surprise me if they get caught out there and we get a gap up, but it sort of looks like they want to do a little bit of a shake and bake and get a little bit lower. So in the short term, I would be a buyer if it opens up much lower for a bit of a rally into the close. If they gap it up, it could be a little bit of a fade. We'll have to see. It's been a bit of a Costanza market here. One encouraging piece, which I haven't heard anyone talk about, is the dollar. It's been making lower highs and lower lows. We got into some reference area, and it's now bouncing back into where the breakdown was. So I sort of like that rallied a bit ahead of the NFP. That is a little bit of a good sign. Anyway, we'll leave it there. I'll pick up on this more in the weekend review. This is getting a little too hard. I would really rather you be looking at the charts with me for this particular discussion. We will do that Sunday. Anyway, if you want to watch this video again or miss some of it, it'll be on my YouTube channel a little bit later. Actually, I'll put it up now, so it should be up there shortly. And if you aren't subscribed to my YouTube channel, it's at Justin Pulitzer Trades. If you're not following me on Twitter, it's also Justin Pulitzer. Just no trades, but just Justin Pulitzer. Anyhow, that's my story. I'm sticking to it, and cheers.